Hello, I'm Stephen from TEFAT, and today I'd like to give a presentation on cash flow statements in financial accounting. I'll just set up the tripod. Okay, I'll just zoom it back a bit. Okay, something like that. So, cash flow statements, an oversimplification would be the cash receipts and cash payments of a company. In fact, that's the way it's taught in business studies in year 11 and 12 in secondary school. But that's a bit of an oversimplification. Now I've got some, I'll just state that cash statements for official reporting for companies have to be templated to International Accounting Standard IA7, and in Australia the standard is AASB 107. So for the Australian Accounting Standards Board, they incorporate International AA7 in their accounting standards. So that changed in, and there's a reference I've got, BDO, which states that as well. And on the 12th of 10th, the 12th of the 10th, I cited both references, and AASB adopted the International Accounting Standards on January the 1st, 2005. So there's many different financial accounting standards, and today we're going to focus on obviously the cash flow statement. And the adoption of those standards back in the mid-2000s was relatively smooth. So that's the reference, the Australian Accounting Standards Board reference on the standard 107 on the cash flow statement. You can view it online. It's a fairly good template. And there's two methods of calculating the cash flow statement. Direct, which is direct, tangible, palpable cash movements. Every single transaction, every single receipt, every single payment has to be measured, recorded, and put into the cash flow statement. That's the direct method. But the indirect method is using the other two financial statements, the profit and loss statement, and the also called the statement of financial performance, and the balance sheet, also called the statement of financial position. You use the data in the financial statements to calculate cash flows. Now that sounds complicated, but for a big company, if you use the direct method, there's a lot of different transactions to record, and it's a much easier methodology to put forward a cash flow statement from the financial statements, P&L and balance sheet, because there's a lot of transactions with the direct method. So you use the financial statements to calculate the cash flow statement in the indirect method. So the indirect method uses accruals, like transactions over two periods, 1 month to the other, as an example, and you'll see that on the indirect statement. Accruals might affect future cash receipts and future cash payments, and they use net income figures and net asset figures from the other financial statements to adjust cash and non-cash items and work out cash flow movements from the financial statement. as I mentioned, that's the indirect method, but as I mentioned with the direct method is the recommended method, but you've got to track every single transaction, payment and receipt. So in effect, the direct method can take more time with data collection, and often the indirect method is favoured with accountants for ease of calculation. But I'll be focusing on the direct method, and the direct method would suit a small company too, who could easily track cash movements, receipts and payments than a big company. So there are three broad categories of cash movements in a cash flow statement: the operating cash flow movement, the investing cash flow movement, and the financial cash flow movement. All categories have receipts and payments, incoming cash and outgoing cash. And all categories should have an opening balance of cash, because capital has to be available for the firm, and you might get transactions just at the just after the calculation of the previous cash flow statement. But when you look at online references, not all of them have an opening balance of cash, I've found. That it seems to be that they've got an opening balance of cash of 0, and perhaps that's logical to clear your figures down to 0 for a cash flow statement. I'm not quite sure how that works, but I definitely didn't see opening stock of cash on some of those examples online. So any positive cash payment, cash flow, is just the dollar sign and the amount. But a negative figure, you don't put a minus in like in maths. You put a bracket around the figure, and that's consistent with all bookkeeping. Any figure with a bracket around it means negative. You minus it in maths. Okay, when you're using your calculator with a plus minus key. So when you see a negative figure, you either use minus or you go plus and plus minus to make it negative. So also I'll give you a summary on the board. Just zoom it in a bit. Okay, I'll just hold the camera there so I can see that it's on pointed at the whiteboard. So you always put a title like you do for any financial statement. Cash flow statement for Boggabri solar panels as at 30th of June 2005. Boggabri is in the New England area in New South Wales. Always put a title or you'll lose a mark. You start with operating cash flow. You've got an opening balance of operating cash plus the cash receipts in this category. Operating minus the cash payments of operating gives you closing balance of operating cash. Then the next category, you list the items for investment cash flows. Start with an opening stock of cash in investment cash plus cash receipts of investment cash flow minus cash payments of investment cash flow gives you a closing balance for investment in the cash flow position. That's for that category. Then the final category is financing cash flows. Opening stock of cash for financing cash flow movements plus cash receipts for financing cash flow movements minus cash payments for financing cash flow movements, and then just pointing up to that spot gives you closing balance of financial cash flow movement. Okay, so now we've got three subtotals for those closing balances for those three categories. We add up categories 1, 2 and 3 in the three categories to get total net movement of cash flow, which is either a surplus or a deficit. sometimes called a gain or a loss. And if it's a positive figure, the dollar sign and the amount. If it's a negative figure, the dollar sign within brackets, and obviously put the figure. So back to the PC, just zoom it up a bit. We're calculating the cash flow statement for Boggabri green energy solar panels as at the 30th of June 2005. I just put that date in, even though it's 2021. You start off with operating activities. So I'll just give the examples quite comprehensive and complete, because often the examples miss figures. This has been calculated according to the AASB reference on cash flow templates. One example of cash receipts is interest received on a fixed investment with CommBank, $1,200. Interest rates are quite low at the moment around the world. Cash from customers, receipts, $800,000 for buying the products. You can do this on Excel, obviously, to make it nice structured with rows and columns, but I wanted to put this in large font on Word. Money received from when customers settle their accounts receivable account and finally pay their short-term loan, $18,000. Cash receipts from a government project to set up solar panels in South Australia, just as an example, that figure. Cash receipts from, this is a supplementary type enterprise. One of the directors is interested in fishing and likes this fishing rod holder, which hasn't got much to do with their main operations of solar panels, but they're deciding to sell it and get a bit of money on the side, $600. Now this is when the company A, the Boggabri Green Energy, their shareholders in another company, Company B, they've actually received a dividend from Company B. Due to their shareholding, dividends were declared. Note that this isn't Company A paying out dividends on their own shareholders. That's in financing cash flows, and it's a negative figure. So this is when the company has received the dividend, okay, from another company, a positive cash flow. Cash to suppliers, which and now we're on to operating cash payments, another category. So we've come from cash receipts, all the listings, and now cash payment. You're not supposed to write cash payments and cash receipts as a subtitle, but I put this in to help with you, because you might be new to cash flow statements. So operating cash flow payments rather. Cash to suppliers, which are payments, paying their suppliers, $75,000. Remember, the figure is in brackets. Cash paid to suppliers in their accounts payable account, their short-term loan to other companies, and they're paying some, settling some, $37,000. Cash payments to an insurance company, $20,000. Paying interest to bank, $2,700 off a loan. So if you're paying interest on a loan, you put that figure in operating cash flow movements. Also, cash payments go here for intellectual property, e.g. payments to buy a patent, $5,700. If it was a receipt, it'd go higher with a positive figure if they were selling a patent, but in this case they're buying a patent. Payments to their employees, $350,000. Payroll, always a big cost for firms. High salaries, a lot of employees. Interest paid to a superannuation entity, senior citizens, which lent money to the business. So they got to pay interest to them. Buying merchandise for a marketing display at Gosford costs them that much. Cash to suppliers, which are the purchase of main inventory items of solar panels, paying out cash to get more inventory, negative cash flow, company tax to the Australian Tax Office, the ATO, at the end of the year. Also the goods and services tax, which is an indirect tax. So company tax is a direct tax, another negative cash flow. No, there's the only certainties death and taxes, I think I've heard. So then you get a figure for total cash movement, a gain or loss in operating activities. So you add up all those receipts, deduct it deduct the payments using your calculator, plus or minus all along, to get that subtotal there for operating cash, okay, which is a positive figure. Then we move on to investment activities, investment cash receipts, purchase or sale of an asset. So in this example, I'm saying if it was a purchase, it'd go below, but if it's a sale of an old asset, like an old tractor, it's a positive cash flow movement, and they managed to get $1,500 for the old tractor from a buyer from a previous agricultural operation. They got out of agriculture and got into solar panels. Sale of a futures contract in the financial market, positive cash flow movement. Any derivatives type figure, both sale or purchase, is put in investing cash flow movement. Sale of a portfolio of shares in Armadale Stationery, got them $5,000. Now we go to investment cash payments in the same category. Payments from mergers or acquisitions go in this particular place in the cash flow statement. So there was a merger or acquisition with PNG, Papua New Guinea Green Energy, and Port Moresby, measured in Australian dollars. Again, a substantial outgoing cash, $800,000 to merge with that group, almost $1 million. Purchase of new asset, machine, an asset to make the solar panels because they're manufacturers. I put in that figure. So purchase of assets goes here. It's a negative cash flow movement. Outgoing cash to get the asset. Purchase of a financial option. Now, an option is a type of derivative. An option gives you the option of buying and selling shares. So a call option is the option to sell shares. A put option is the option to buy shares. I often get a bit worried if I've got that wrong, and I'll probably review that, but check up what an option is. A swap is another type of derivative where there's a buyer and seller who they just basically swap something in the financial market, such as a foreign exchange position. So a swap, if you're purchasing a swap, it's a negative cash outflow. So now you add up all those items for investing activities, cash flow movements, to get the total subtotal, and in this case it's a negative cash flow because of that merger with the group in PNG. But in time they'll get future profits, so that should go positive again. Now we go to financial activities. Financial cash receipts. Bank interest received, $900. That's interest earned. Cash proceeds from issuing bonds. So the bonds were raised to bondholders, and the bondholder is giving a loan to the company. So the company gets cash as part of their operations, but they have to pay back those bondholders, and the bondholders get coupon payments at the coupon rate. So that's why the firm issues bonds to generate cash. It's like a loan to bondholders. Cash proceeds from issuing all these financial instruments, debentures, loans, notes, bonds, mortgages, and other short-term or long-term borrowings. That's from page 7 from AASB. Accounting Standard 107. So a debenture, similar to government bonds, but that's a loan by the government. A debenture is a loan to from a debenture holder to a private company. So different in that way, because a debenture is in the private sector. And so they advertise for debentures. They want new debenture holders, and they put an advertising campaign in one of the newspapers, the Sydney Morning Herald. I used to see ads for companies trying to get debenture holders. Long-term loan from Envero Bank. So the bank loans money to the company, so the cash flow is positive, even though the interest and principal have to be paid off in the long run. In the short term, they generate cash from the loan. Short-term loan from a pawn shop. The company's having a rough trot, $500. Inflow of cash from a company investment, Ballina brackets, as a shareholder and dividends. Positive cash flow movements is dividends. A share issue, new shares issued on the share market, the New York Stock Exchange and Australian Stock Exchange, ASX, quite substantial, $1 million. New shareholders, new capital. In the old days, share issue was application and allotment with part-time ownership of shares until full ownership, but now most of the stocks are sold dollar for dollar and they're fully paid up stocks. But that's a bit old-fashioned application and allotment from the 19th century. But we're considering fully paid shares in the new issue. Proceeds from taking out short-term debt from a dodgy money lender, $10,000. Another short-term loan. Interest received on investment we mentioned. Now we consider the financial cash payments. We've just mentioned receipts. So now it's outgoing cash. Payments for repurchase of company shares. That's when the company repurchases shares from shareholders. They want to put those shares in the company name. Repayment of asset leases costs. Also, leases, outgoing cash. Pays some principal back to Envero Bank. Payment of dividends to Boggabri Green Energy shareholders. $80,000 total in dividends was declared for the year. Perhaps dividends are quite low at this stage because the company is a start-up business. Now, Boggabri Green Energy is lending out to Fiji Renewable Energy and Suva. That's a loan they're giving another entity. Outgoing cash as well. Payments for repurchase of company shares we mentioned. Trade in shares to invest in preference shares in really good battery company. So preference shares is when the preference shareholders gets access to dividends before ordinary and deferred shareholders. In this case, Boggabri is investing in another company, really good battery company. So they've got to buy the shares, so it's outgoing cash. Repayment of debt capital. Any debt capital repayment is put in this section. Capital leases we mentioned. Payment of dividend tax is put here. Now if there is one in your country, now you get total financial activity loss or gain. It is a loss. The figure's in brackets. If there was no brackets, the figure would have been a gain. So now what you do is you add up the total operating subtotal of cash flow movements, the total investment cash flow movement subtotal, and that figure, the total figure for financial cash flow movements, to get the total net increase or decrease in cash. So you add that figure to opening stock of cash right at the top of the statement, and in this particular cash flow statement it was a huge negative figure. But remember, didn't we mention there was a merger which would have put a bit of pressure on the cash flow statement, and that enterprise will yield profits in the long run. So in summary, you get a subtotal for cash in those three categories: operating, investment and financial. You add them all up, add that to opening stock of cash at the top of the cash flow statement if there is one, and you get the net movement of cash, the total movement of cash for the corporate entity for the year. And yeah, I was taught that there was an opening balance, even though you might not see one from last period, because capital has to be available to the company, and that's a cash measurement. And again, about positive or negative figures, sometimes they're even printed in red ink, the negative figures, to highlight outgoing cash, and black ink for receipts. So if the entity did have a negative cash flow movement, there's no need for alarm bells just yet. The enterprise was only a startup business 3 years ago, and solar panels are highly in demand with talk of a new government subsidy. Everyone seems to be putting solar panels on their roof. Remember that Green Energy, for short, has lent money to a renewable energy company in Suva, which will eventually be paid. They've acquired that entity in Port Moresby, which will yield profits in the long run, and that enterprise, I put in the example, is backed by the PNG government. They have invested in preference shares in really good batteries, which should yield healthy dividends over time. They had to pay their shareholders. And I put in this example the financial analysts in the press, investors and finance managers are writing up that Green Energy are expecting short-term liquidity issues, liquidity being the access to solid cash, to be only temporary, with an increase in cash over 2-3 years with the operations of Port Moresby flourishing. That L is probably just where I pressed the keyboard when I started up the computer after a sleep. So, like, there could be red flags too in another corporate entity or company or sole trade or partnership of cash flow problems, liquidity issues, the entity's ability to be able to access cash in the short term, liquidity, and insolvency, an inability to pay your debts, both in the short term and perhaps the long term too. So the cash flow statement is a useful financial statement to highlight those issues. And the cash flow statement has to be attended to first, because you might be able to put off losses on the P&L for future years and write off in tax, and you might be able to restructure a company and get a better balance statement. But a negative, I say negative in the context of too much outgoing cash. It's has to be addressed in the here and now, and the issue is very telling. Okay, So it's a red flag, could be a red flag for another company. A company is not allowed to trade when insolvent. ASIC regulates the Act, which is the Corporations Law of 2001. You're not allowed to trade when you're insolvent. If the directors of a company trade when they're insolvent, they could be liable to fines, even, prison sentences if it's bad enough. So look up the Corporations Act 2001 if you're interested. If you're doing corporations law, about the section on insolvency. Now I've got another example. I'll give a hint. This one's a little bit better. This cash flow statement 2 years later in June 30th, 2001. Start with operating activities. This time I'm not giving subtitles of cash receipts and cash payments. I'm just giving it as is in cash flow statements. Cash from customers or receipts. Cash received from customers and accounts receivable who are settling the accounts receivable account. That fishing rod holder enterprise, bit better this year, $800, $200 better than 2 years ago. This enterprise is better than a poke in the eye. They are getting a bit of positive cash flow movement in it. The government project in South Australia again, yielding positive cash. Receiving dividends from Brisbane Solar Batteries in this example, $2,000. Cash receipts for the sale of a patent. They're selling a patent, so it's a positive cash flow movement. Cash to suppliers, which is a payment. Paying interest in the bank, included in operating cash movement. Cash payment to British insurance company. We're really British insurance company. $40,000 in negative cash to purchase insurance products. Payment to their employees. The payroll bill went up a bit compared to 2 years ago. Interest payments to the lender of a loan, National Australia Bank. Buying merchandise. Company tax. Goods and services tax, the GST. So total cash flow movement is a gain in operating category of 902,100. Now we go to investment. Sale of an old asset, again, an old tractor. This time they got a higher price. Must have been a tractor in better condition. Cash received by sale of a futures contract in the Sydney futures market. And what is a futures contract? It's when it started in around the Chicago area in the Midwest in the 19th century, and it's when, say, a wheat seller gets a guaranteed future price of the wheat because the ice used to freeze up around the Midwest. So they wanted a future price, but they had to get a buyer with another position who takes the opposite position with price and the opposite part of the transaction. So the risk either goes one way or the other, and one party wins, one party loses in the futures contract. Sale of shares, obviously positive cash flow. Payment from mergers or acquisition. Now we're on to cash payments. That Port Moresby entity. Purchase of new asset, machine, this time a lower price for the machine. Cash payment for a put option. That's an option to buy shares, and I hope I haven't got that wrong. Please look up put options. I think I have got it right, actually. Call option is for selling. Cash payment for a swap. A swap again in the financial market where one party swaps and something such as an asset with another party who's willing to do the swap, who's got something else. Could be something like an investment at different interest rates is swapped. It is possible. There's a number of different possibilities in the derivatives market. So now our total investment activity is a loss figure in brackets for investment cash flow movement. Finally, financial cash flows. Interest received on investment. Inflow of cash from company investment as a shareholder. Whether it's a dividend or perhaps interest received. I just left that pretty broad, probably dividends. Cash proceeds from share issue. New share issue is a positive cash flow. So is bonds between the company and the bondholder. Bank interest from CommBank for a fixed interest term deposit. Proceeds from a long-term loan with fictitious Indrail Bank. Also a positive cash flow movement. A short-term loan from the local pawn shop. Also listed in positive cash flow in financing category. Now your payments. Paying your shareholders dividends, outgoing cash. Paying back some principal back to a bank. Negative cash flow. Payment of dividends we mentioned. A loan to Fiji Renewable Energy and Suva, also a negative cash flow, but it will be positive in the long run because eventually Fiji Renewable Energy will have to pay back both the principal and interest on the loan. Payment for repurchase of company shares. They wanted to get some shares from the shareholders, buy them back. So again, outgoing cash to buy those shares. A trade in shares and preference shares in really good battery company, $30,000. So buying shares, negative cash flow movement in the financing category. Repayment of any debt capital in this category, capital leases as well. Finally, your taxes and dividend taxes put in this category. Actually, some tax is in the operating section. Just double check on that. That dividend tax might not even be Australia. It could be somewhere else in the world. So let's go back to operating. Just scrolling back. Just check where company tax and let's put here the GST. So that's just one type of tax, that dividend tax. But items such as company tax and GST go in operating category. This particular tax goes in financial category. Okay. So check up on the different categories and examples and get the idea that operating is like your normal operations, investing is buying and selling assets, as an example. Financing is any cash flow movement to do with loan instruments and also paying your dividends. Just get used to the items in the different categories. So in this example, we've got a positive cash flow. If it was a loss, that figure would be negative. I put in brackets. So we've got a positive cash flow movement for that year, so that's good news. A cash surplus. That figure is derived by adding up any opening stock of cash figures in the categories or on the top of the statement, if it's some sort of an anomaly of cash. And my sources, all cited on the 12th of the 10th. Oh, that's not the Middle Ages. That's 2021. Good. So that resource by the Australian Accounting Standards Board, Standard 107, that reference there, and the other reference BDO. End of the presentation. Thanks so much for watching. Stephen from TEFAT in Sydney. I'll just point it on the whiteboard just one more time before you go. And just that's the summary again. Positive cash receipts in, negative cash payments out in each category. Add up all the subtotals in each category, 1, 2 and 3, to get total cash flow movement for the year, either a surplus or deficit. Again, thanks for watching. I am Stephen, and from TEFAT. Bye.